Good morning, everyone. I am John Wilson, Head of Technical at Dalriada. Welcome to this September Future Influencers webinar. I will get to the agenda and speakers for today presently, but just very quickly some housekeeping. So the platform for today's event is Teams Live. This means that you'll be able to hear all the speakers, of course, but for engagement by attendees, which is very much encouraged, I would direct you to the Q&A box, which hopefully you can see in the top right-hand corner of your screen. If you've got any comments, observations, or anything else that you would like us to cover during today's proceedings, then please pop something into the Q&A box. I will keep an eye on it, and when I get an opportunity, I will read out the questions and get the appropriate speaker to respond. We should also have a bit of time towards the end if there's any discussion. So turning to today's agenda, a variety of topics, but very much issues that are either ongoing at the moment or will be something for trustees or pension scheme sponsors to consider in the coming months. First up, we have our own Adrian Campbell, who is looking at the recent consultation on the funding of defined benefit pension schemes, and we'll speak to the direction of travel there and some of the things that stakeholders should be thinking about before we have a new funding regime come into force, which could happen as soon as, well, within a year of this month, possibly October, November 2021. The first consultation on scheme funding has now completed. We're expecting a bit more detail, and Adrian will tell you about that. We then have Jane Howe from Eversheds joining us, doing a case law roundup, but with a particular emphasis around the Pension Protection Fund and the levels of compensation that are paid to members of schemes that enter the PPF after an assessment period. And continuing the kind of hot topic theme, I then just want to finish off with a bit of a roundup of some of the other things that trustees and/or scheme sponsors should probably have on their radar, either this month or for the last quarter of 2020. So without further ado, I believe I'm handing over to Adrian Campbell first to speak to scheme funding. Adrian.
Thank you, John. Good morning all. I'm Adrian Campbell and I'm a fully accredited professional trustee at Dalriada, and I work in our London office. I've been at Dalriada for just over 3 years now. Prior to that, I worked at the pensions regulator for 8 years as a senior case manager in their risk and funding team. Today, I'm going to present to you an overview of the proposed revised defined benefit funding code that the pensions regulator is currently consulting on. Recently, I and many of my colleagues attended a 2-hour webinar that the pensions regulator hosted on this. And I have to say, although it was very informative, 2 hours was quite a long session. Therefore, for the 20-minute slot I have today, I have made my presentation a bit more high level rather than going into swathes of detail. So therefore, I hope you all have your coffee, tea or cans of Coke ready while I canter through. I hope you find my presentation informative, and please feel free to raise questions, which I'll happily attempt to answer at the end. Slide 2, please. Kaz. TPR commented at their recent webinar that the DB funding landscape was working largely as intended. However, there needed to be some improvements and changes so that it was sustainable in the future. In particular, it highlighted 3 things. Firstly, that the DB landscape was maturing and how important it was for trustees to take a long-term view to their approach for funding. so that the end game for their scheme was dealt with. Secondly, the white paper also acknowledged that although risk is part of the system, it is important to make sure that the flexibilities that are built in are used appropriately. And thirdly, the lack of a clear agreed statement for funding was making the regulator's job more difficult to take efficient actions when they see potential non-compliance. So to improve on these things, the white paper has proposed new legislation and a new code of practice on defined benefit funding. So what is in the pensions bill? So far, the 2018 pensions bill has been scrutinised by the House of Lords and is about to start its passage through the House of Commons. It contains a few important clauses as it currently stands, but we should be mindful that these could change as it goes through the parliamentary process. The first thing is that trustees will have to determine a funding and investment strategy for ensuring that pensions and other benefits can be provided over the long term. In consultation, this is referred to the long-term funding target, as this is a term widely used by industry. Secondly, trustees will have to develop a statement of strategy, which will have to be submitted to the regulator alongside relevant valuation information. Thirdly, all schemes will have to submit a valuation, which is a key change from the current requirements, as where schemes only in deficit will have to submit a valuation. So that's quite a key change. Another requirement is that the technical provisions are calculated so that they are consistent with the scheme's funding and investment strategy. This means in practice that technical provisions will become milestones on the journey to the long-term objective. Finally, where trustees have failed to meet the requirements of the funding and investment strategy, the regulator will be able to direct trustees to revise their long-term objective. This will be in addition to TPR's current Section 231 powers, where it can set the technical provisions and impose a recovery plan. Slide 3, please, Kaz. The regulator are consulting on a revised DB funding code in two parts. The first consultation running considers the new proposed regulatory approach and the principles the regulator thinks should underpin the new framework and how they could be applied to practice to provide clearer guidelines. This consultation actually closed on the 2nd of September, although the regulator has agreed some extensions to those that have requested more time. The second consultation planned for is planned for spring next year, and this will focus on the draft code itself and what final guidelines might look like, informed by industry feedback to this current consultation. TPR's impact assessment and changes to the legislation and regulations will also be considered, and the regulator are keen to involve the pensions industry as much as possible in helping them define what good looks like. In particular, they are keen to understand if there are any practical issues or unintended consequences arising from their proposals. TPR are seeking to create a sustainable framework which provides the right balance between the security of member benefits and the cost to employers of running their DB schemes. Although the proposed framework may be a departure from their current DB codes, many of the core principles are consistent with their messages over the last few years, such as integrated risk management and the importance of long-term planning and the good practice that many schemes already apply. TPR have also stated they do not expect their new proposed approach to be too onerous for most schemes to implement, but that they appreciate there could be a significant impact for some schemes, particularly for those that have been running excessive and unjustifiable risks. Slide 4, please, Kaz. So the key principles of the consultation, TPR have identified a number of overarching principles that they believe should stand behind all scheme valuations. These are based on the experience from reviewing thousands of scheme valuations and ongoing engagement with a wide range of stakeholders and current forthcoming legislation. So drilling down to each of the proposed principles. Firstly, compliance and evidence. The regulator expects trustees and employers to be able to understand their scheme-specific funding and investment risks and objectively evidence how these risks have been assessed as remote or minimal or can otherwise be properly managed. Robust evidence should be provided when risks are generally unsupportable. When demonstrating how risks are managed, trustees should be able to compare the risks they have taken to a tolerated risk position and then demonstrate the mitigation and or support available. The long-term funding objective. So this is a key part of the consultation. By the time schemes are significantly mature, TPR expects schemes to have a low level of dependency on the employer and be invested with high resilience to risk. Therefore, journey plans and technical provisions, they expect trustees to develop a journey plan to achieve their long-term objective. Also expecting trustees to plan for investment risk to decrease as their scheme matures and reaches low dependency. And that the technical provisions should have a clear and explicit link to the long-term objective and over time should converge to the LTO as evidenced by the journey plan. In respect of scheme investments, the actual investment strategy and asset allocation over time should be broadly aligned with the scheme's funding strategy, and trustees must ensure that their investment strategy has sufficient security, quality, and can satisfy liquidity requirements based on expected cash flows, as well as reasonable allowance for unexpected cash flows. They expect the asset allocation at significant maturity to have high resilience to risk and a high level of liquidity and a high average credit quality. Moving on to reliance on the employer covenant. I think this really sort of stays the same. Schemes with stronger employer covenants can take more risk and assume higher returns. However, TPR state trustees should assume a reducing level of reliance on the covenant over time, depending on its visibility. Reliance on additional support. Schemes can account for additional support when carrying out their valuations, provided that it provides sufficient support for the risks being run and is appropriately valued and is legally enforceable and realisable as its necessary value when required. And finally,
Adrian,
yes.
sorry to interject there, Adrian. Just something popped up on the question and answer box, that perhaps the slides are running one behind the topic that you're speaking to.
Oh, okay. Yes, I'm having difficulty actually seeing the slides my end. I'm now going to move on to slide 5, please. Yeah, sorry, I think it would be the next one. Apologies. Thank you for pointing that out. I'm now going to talk to you about the new regulatory approach for fast track and bespoke. In the government's white paper highlighted the need for greater clarity about what the pensions regulator expects of trustees for greater accountability around their decision making and clearer parameters around the use of flexibilities in the regime. However, TPR have stated they do not intend to reintroduce a one-size-fits-all funding standard. Instead, they have sought to reconcile the need for a greater direction with the scheme-specific funding regime by proposing a twin-track compliance route to carrying out valuations, which is referred to as fast track and bespoke. So setting out the differences as per the slide for fast track and bespoke. For fast track, the regulator will be setting straightforward quantitative compliance guidelines for trustees to assess whether they would consider the valuation compliant with the legislation. And if all aspects are satisfied, trustees can expect minimum regulatory involvement on DB funding for their valuation. Versus bespoke, this option provides trustees and employers with more flexibility to account for scheme and employer specific circumstances. Decisions in this route will need to be fully articulated and evidenced and may mean higher regulatory involvement. So TPR anticipate that the twin track approach will introduce greater clarity for trustees and employers so that they can understand whether and why the regulator may have concerns about their funding arrangements and what can be done to lessen those concerns. In addition, advisors will be able to provide advice to their clients with more certainty, and savers can be confident that those responsible for their pensions have acted appropriately and with more accountability. Trustees opting for either route will have to submit evidence to the regulator, and obviously to a greater degree for bespoke, demonstrating their approach to managing their funding and investment risks as part of the new statement of strategy introduced in the Pension Schemes Bill. Receiving this information at the outset will help the regulator assess valuations against their guidelines and avoid unnecessary engagement with trustees who have provided clear explanations and evidence. Trustees would not be expected to maintain the previous approach, e.g. fast track or bespoke at future valuations, because understandably they may have to change with the change in any employer and scheme circumstances. So an overview of fast track is that it's relevant for trustees who can submit a valuation that is compliant with the regulator's code guidelines. Trustees can expect to provide less evidence for their valuation submission and to receive much less regulatory scrutiny, expected to ease the process for well-funded and well-managed schemes. And it would set clearer expectations and provide an easier route for compliance for trustees of smaller schemes. An overview of bespoke is that it's relevant for trustees who cannot or choose not to comply with fast track. They will have to submit their valuation along with supporting evidence explaining how and why they have differed from the fast track position and how any additional risk is being managed. Bespoke arrangements may receive more regulatory scrutiny, but it's not a bad or second best option. And for both bespoke and fast track approaches, if it's done correctly, they are equally compliant with the legislation. So there may be reasons why trustees choose to opt for the bespoke route. Some may want to take additional managed risk relative to the tolerated level of risk as set out in fast track, whereas others may agree funding solutions that represent an outcome as least as good as fast track overall, but do not satisfy all of the individual fast track guidelines. Next slide, please, Kaz. Apologies for that delay. On to slide 6. So these are sort of observations on what we know so far and the sort of direction of travel. So it's obvious that the Code of Practice 3 is no longer fit for purpose. So it's a little like, I suppose, the Data Protection Act 1998 was no longer fit for purpose with the development in technology, etc. The Code of Practice 3, which is the 2014 version, is struggling, and the developments in the pensions market have moved on since the Pensions Act 2004, such as the different valuation basis and the understanding of interconnectedness of the risks. In relation to the SFO progressing to the LTO, which is the long-term funding objective, this was previously introduced by the DWP as the long-term target, with the technical provisions position and valuations with any recovery plans just being as stepping stones to get there. This, I guess, was illustrated very well recently by TPR on their recent webinar, with the proposed choice of fast track valuation with risks restricted to being within certain tolerances, or bespoke, supported by section 231 of the current pensions bill, which provides the regulator with the power to give direction to revise the long-term objective should it need to. So the clearer funding standards, this begins to provide a basis for clearer funding standards, and although the details of tolerances of the fast track valuation basis have yet to be determined, it does seem to indicate that schemes with unusual valuation approaches are likely to be sort of confined to the bespoke route, with all of the required justification. On this one occasion, however, the answer, according to the DWP and TPR anyway, is not blowing in the wind. It is aimed at the SFO being nailed down, very visible within tolerance levels, objectively being measured, with all of this being wrapped up into governance so tight that it sort of squeaks, providing value for money and being certified by the chair in a new DB pension scheme statement, provision which is all in the pension schemes bill, which will no doubt be in the public domain. So working together to deliver the DWP challenge with an effective regulatory framework, the regulator believes that simplification is required, hence the fast track and bespoke proposals. However, this is not just a challenge for the regulator, it's a challenge for the industry, where we really will have to work together for a better outcome. If the industry and the regulator can work together to agree a sensible tolerances for fast track, which means that a large number of schemes can go down that route, then simplification may be achieved. More resources could then go into fighting pension scams and delivering better value for members, rather than just arguing over valuations. The comment from the regulator last first on the recent webinar was that it was trying to clarify what an effective funding regime looks like, balancing the principles of affordability and member security. So importantly, if the tolerances are too onerous, we retain 6,000 bespoke valuations for which the regulator has already conceded it's struggling to effectively regulate. And I guess most of you will be seeing sort of articles and other commentary coming out on the new proposals. So I guess there's quite a long journey to go, and especially with the phase 2 of the consultation. And here at Dalriada, we will want to have our say, and I'm sure that those of you on the call working for the pension organisations that you're with will want to have your say too. And thank you. That's the end of my presentation. And I'm now going to pass over to Jane Howe.
Thank you, Adrian. Morning, everyone. My name is Jane Howell, and I am an associate in the pensions team at Evershed Sutherland, based in our Manchester office. This morning, I will be doing a brief roundup of some case law focusing on PPF compensation levels and mainly around the compensation cap. If we can move on to the next slide, please, Caroline. Right, so as I'm sure you're all aware, the PPF, the Pensions Protection Fund, is a lifeboat scheme which provides compensation to members of eligible defined benefit pension schemes with an insolvent employer if the scheme's assets are insufficient to cover the PPF compensation levels. The amount of the compensation that is payable to the scheme members and other beneficiaries depends on several factors. These include the status of the beneficiary, for instance, whether the beneficiary is a pensioner, postponed pensioner, deferred member, active member, or a dependent of somebody in any of these classes, the accrued entitlement of the member or dependent, or the amount of benefit payable to the member immediately before the PPF entry process began, and whether any of the scheme rules have been excluded and therefore not adopted by the PPF. The PPF compensation provisions have always incorporated this cliff edge distinction between those members who are under their normal pension age at the date of the insolvency, which is the assessment date, and older members. For those who are at or over MPA at that date or have retired due to ill health, the PPF pays broadly 100% of their scheme entitlement. However, benefits for those under the MPA are cut back in two ways. The first is an automatic reduction to 90% of their benefits, and the second is the compensation cap. This cap was originally set so that it was 90% of the level of benefit in 2005 of £25,000. With indexation, this has become a little over £36,000 by 2019-20. Changes have also been made in 2017 that provide a higher cap for members who have over 20 years of service. In addition, all members, regardless of age, will see changes to the calculation of indexation and survivors' benefits. Now, most members are not hit by the cap, but for the small number of members who are, the implications can be quite harsh. And this has led to some recent cases where the cap has been challenged. And there's also been some consideration on the level of compensation that's provided in general. Move on to the next slide, please. Okay, so the first case I'm going to look at is Hampshire and PPF, which was considered by the CJEU in 2018. Now, I know it's a little while ago, it's not really a recent case, but there's some key points from this case that crop up in Hughes and PPF, which I will cover later on. So this case was brought by Mr. Hampshire, who was a member of the Turner and Newell pension scheme from 1971 to 1998. His scheme went into a PPF assessment period in 2006, when he was still below the scheme's normal retirement age, and he was 4 years from taking benefits unreduced. Now, these are the circumstances in which PPF imposes a cap on the compensation payable. And the effect of this was that Mr. Hampshire's pension was reduced by some 67%, from just over £60,000 to just under £20,000. The impact on his benefits would have become increasingly worse over time, as the PPF does not provide increases on pre-97 benefits, which is when most of Mr. Hampshire's service has been. Had he been over NRA, no such reduction would have been applied. So Mr. Hampshire brought a challenge on the lawfulness of the reduction of his benefits on the basis of Article 8 of the European Directive on protecting the rights of employees in the event of the employer's insolvency, which I've set out on the slide. In summary, this states that the member states must take the necessary measures to protect the rights of employees and former employees on an employer's insolvency to an immediate or prospective entitlement to old age benefits, including survivors' benefits. This requires member states to protect pension rights following corporate insolvency, and previous CJEU decisions have held that the minimum level of protection required was 50%. Though the UK argued that this test was satisfied if on average members received 50% of their benefits rather than each individual. Move on to the next slide, please. So what did the court decide in Hampshire? So the CJEU upheld Mr Hampshire's complaint in robust terms and said that every individual employee must receive old age benefits corresponding to at least 50% of the value of his accrued entitlement under a supplementary occupational pension scheme in the event of his employer's insolvency. The protection test was not satisfied by looking at what members receive on average. This means that the existing PPF caps on compensation will not be lawful for some members. In addition, the CJEU went on to say that PPF compensation should never fall below 50% of a member's accrued entitlement, meaning that promised pension increases, including those relating to the pre-97 service, need to be taken into account in calculating the amount of PPF compensation to be paid. This was a significant judgment, and it was anticipated at the time that there would be a number of wider implications for the PPF trustees and scheme members. Now, there's always been an obvious and material difference in protection offered in the UK between those at NRA and those who have not yet reached that. And this case also highlights that there can be a material impact on a member where there's no protection in place for their increases before 97. A few months after the judgment, the PPF announced that it's intended to comply with the CJE ruling by carrying out a one-off assessment of the actuarial value of a member's accrued entitlement based on assumptions as to the duration of the member's retirement and future changes to inflation. If this assessment revealed the actuarial value of the standard PPF compensation, which the member would otherwise be entitled to receive, would be below the 50% of the actuarial value of their entitlement under the scheme rules, the starting level of their compensation from the PPF would need to be uplifted until the 50% test was met. There would be no future adjustment in the light of subsequent events, and any arrears of compensation for those already receiving benefits would be subject to any applicable limitation period under the Limitation Act. And that was where they left it, though it does get picked up again later on. But if we can move over to the next slide, please. The next case which occurred chronologically was the case of PSV and Bauer, and I apologise, I'm not going to attempt to pronounce the German name of what is the PPF equivalent. This was a German case looking at the limits on PPF protection and the compensation provided by such entities. So in this case, Mr. Bauer's benefits were transferred to the PSV, but before they were transferred, they had been paid at a reduced level in accordance with German law. This is because his employer had experienced financial difficulties and had been authorised by the relevant national authorities to reduce the amount of pensions paid. Under German law, they were required to offset this reduction. However, before they did, they entered insolvency proceedings. Following the insolvency, the PSV refused to make good on the past underpayments. Mr. Bauer complained, and ultimately this was referred to the European Court. The court was asked to consider several questions in this case, including whether the refusal to assume liability for the underpayment complied with Article 8 of the Insolvency Directive. Following the case of Hampshire, the court confirmed that in the event of an employer's insolvency, Article 8 did require a former employee to receive at least half of the benefits that they have out of their accrued rights from the pension scheme. In addition, the losses suffered by the employee as a result of any reduction to their benefits must not be manifestly disproportionate. The objective of the Insolvency Directive is to offer protection to employees in circumstances which represent a threat to their livelihood, and it follows that that a reduction in benefits will be manifestly disproportionate if the employee's ability to meet his needs is seriously compromised. This was deemed not to be a subjective test by reference to the employee's own standard of living, but an objective one looking at whether the employee would be living at or living below the at-risk of poverty threshold as determined by Eurostat for each member state concerned. Interestingly, this decision of the court was contrary to the usual practice in that it did not follow the AG's opinion. The AG's opinion had implied that 100% compensation would be required, and instead the court reaffirmed previous case law. If the AG's opinion had been followed, this would have had a major impact on the solvency of the PPF. So implications for this case aren't particularly that wide-reaching for the UK. The most recent Eurostat figures for the UK are at just over £11,000 for a single person to be above the at-risk of poverty threshold. As previously stated, the PPF compensation cap for 1920 is just over 36,000. So members who are affected by the compensation cap are unlikely to receive any more as a result of the decision in Bauer, as they will sit comfortably above the at-risk of poverty figures. However, any members who might have very low benefits and no other sources of income, a 10% reduction in their benefits might take them below the at-risk of poverty threshold. However, these amounts are likely to be small, so no significant additional liabilities are likely to be incurred by the PPF. However, one risk would be that if the PPF needed to test each member's overall income to see if it was above a certain threshold, admin costs might be likely to arise. The PPF made no allowance for Bauer in the levy determination for earlier this year, and they didn't change the basis of the levy calculation to allow for it. The PPF also stated that they consider that the implementation methodology they announced following Hampshire to ensure all members receive at least 50% of their accrued benefits meant that they were meeting the requirements set out in Bauer. Move on to the next slide, please. Right, so the final case I'm going to have a look at is the case of Hughes and PPF, which was heard earlier this year in the High Court. In this case, Mr. Hughes had retired early with a scheme pension of around £66,000, which translated to roughly only £17,000 of PPF compensation. This was a reduction of over 70%. Mr. Hughes was the lead claimant of 24 other members of various schemes, including Turner and Newell, Heath and Lambert, and BMI. They claimed that the compensation cap was age discriminatory. One of the other claimants in this case was Mr. Hampshire of Hampshire and PPF fame. Following the decision in Hampshire, as we've discussed, the PPF intend to carry out a one-off assessment to make sure that members' benefits would be at the 50% level required by the PPF, and would look at no future reassessments of that to make sure it remained at the correct level. The claimants argued that this one-off assessment and adjustment carried the risk that if the actuary's assumptions are not borne out in practice, for instance, if the member lives longer than is expected, the PPF compensation received would not meet the 50% minimum threshold. They were arguing for a year-on-year assessment. In addition, they also raised a specific point regarding the calculation of survivors' benefits, where PPF compensation payable is 50% of the member's pension at the date of death. The claimants pointed out that this calculation basis may not provide 50% of what the scheme would have paid to a survivor. For instance, if the scheme rules provide for a pension of 2/3 of the member's pension before any computation for a lump sum. Move on to the next slide, please. So what did the court decide? The most groundbreaking part of the Hughes claim was that the compensation cap amounted to an unlawful direct age discrimination, given that it only applies to those who have not reached a specified age at the assessment date. Sensibly, the PPF did not attempt to argue that there was no discrimination, but instead sought to demonstrate that there was an objective justification. They put forward two legitimate aims, which they said were the argument was put forward that the cap provisions were a proportionate means of achieving two legitimate aims. The first of these was to combat moral hazard by creating a clear incentive for senior decision makers to ensure that schemes were properly funded, rather than just relying on the existence of the PPF. And the second was to ensure that the costs of the PPF through the levy were not so high as to deter employers from continuing to provide the occupational pension schemes. The judge accepted that both of these aims were legitimate, and also indicated that the 90% limit on benefits for those below the normal pension age would potentially be appropriate and necessary. However, the compensation cap was disproportionate and therefore unjustifiable. It affected only a very small number of members, but had a very significant adverse effect on those members. Against that background, it was difficult to see that the cap added anything material to the effects of the 90% limit in achieving the identified aims. As for the PPF's proposed route to implement the 50% rule from Hampshire, the judge opted for the middle ground. He said that a year-on-year assessment against the 50% threshold was not required. However, what must be provided is 50% of the actual value not the predicted value of the member's pension. So if there is a risk of any member receiving less than that, the PPF must have a way of identifying and dealing with it. But he left it up to the PPF to figure out what that would be and how they would do it. On the related survivors' pensions point, the judge agreed with the claimants. Although EU law is concerned with protecting the rights of employees, it recognises specifically that those rights include the survivors' benefits. Therefore, payment of less than 50% of the value of the benefits is not sufficient. This then means that some key features of the PPF compensation regime that have been in place since 2005 have been held to be unlawful from day one. The obvious question that arises here is whether full arrears of compensation must now be paid to the affected members, or whether claims would be time barred. The judge found that a 6-year limitation period would apply to claims for PPF compensation because the PPF is a statutory scheme and there is specific limitation in the Limitation Act for claims under statutory enactment. However, for schemes that are outside the PPF, the starting point would be that no limitation period applies unless a forfeiture provision is within the scheme rules, which is something that we might all recognise from the first Lloyds GMP case. For schemes in a PPF assessment period, against the judge said no limitation period would apply to them. Given that some schemes have been in the assessment for 10 or 15 years, this means that substantial sums could be due. Move on to the next slide, please. So what is the impact of this decision? Well, the fact that the compensation cap, which is a central pillar of the PPF compensation regime, has been held to be unlawful does sound quite problematic, but it's worth noting that only about 0.5% of pensioners currently in the PPF are actually affected by the compensation cap. For those members, as well as those schemes in assessment periods, the declaration that the cap is unlawful will be significant, but it shouldn't create huge disruption for the PPF or schemes in general. The PPF actuary has valued this as a roughly £200 million issue for all of the PPF's current pensioners. The PPF's chief actuary did not appear to believe that the presence or absence of the cap would affect the amount of the levy required to be collected. Nevertheless, schemes with a higher than usual number of members subject to the cap could see an impact on their PPF funding position and possibly therefore their individual levy. This may be relevant to certain types of executive arrangements or schemes that are in certain industry sectors that have typically higher than normal earnings, which would be things like aviation or the financial services. The decision for the 50% test to apply separately to survivors' benefits is also potentially material. The PPF has said it is looking into the detail of the judgment and deciding which steps to take next, and the PPF have lodged an appeal on the 20th of August against the ruling, particularly on the approach that the PPF may adopt to meet the requirement for members to receive 50% of the value of their entitlement and how survivors' benefits should be dealt with. We're still waiting to hear whether the Court of Appeal will allow the appeal to proceed. For the meantime, the PPF have confirmed that they will continue to pay members' benefits at the current level. As the government sets the level of compensation that the PPF pays, the Department for Work and Pensions has also lodged an appeal against the ruling on the cap. Again, the PPF have confirmed that they'll continue to apply the cap according to the current levels set by the DWP until they hear any differently. And that's all I was going to cover, so I will hand back over to John now.
Thanks, Jane and Adrian. So I think just for maybe the next 5 or 10 minutes, I wanted to kind of continue the hot topic theme and just cover off a few other issues to think about this month and the next few months that we've not really already touched on. So if we could move on to the next slide, please, Cass. Yeah, I think it would be very, very difficult to have a pensions hot topic seminar at the moment without making some reference to the ongoing impact of the pandemic. So just a quick mention of COVID-19 in a couple of contexts, actually. First of all, hopefully most trustees and pension scheme sponsors are aware that over the past 6 months or so, the pensions regulator has published guidance on COVID-19 and in particular has offered various easements to pension schemes in terms of things like reporting, employee consultation, and in the first few months after March, also a few relaxation in terms of payment of deficit recovery contributions and other contributions to pension schemes as well. Now, the current guidance, which was issued in July, is due to expire at the end of this month, and there's been no word from the pensions regulator on any new guidance. So I take from that at the current time we are to assume that the normal rules in terms of pension regulator enforcement will recommence again from the 1st of October. So that will affect things like reporting of late accounts and also employee consultation on changes to things like levels of pension contributions. And just taking a step back in terms of the impact of COVID-19, the end of the pensions regulator guidance coincides quite roughly with the end of government support schemes for employers generally, things like the coronavirus job retention scheme. And you know, I think it's probably fairly obvious to say that, you know, the economic impact of COVID-19 has probably not yet been fully felt, and perhaps will only begin to manifest itself properly once the taxpayer subsidy schemes, which is effectively what they are, come to an end in the next month or so. And some of the impacts on that for trustees and employers, you know, in addition to the funding of pension schemes, is, you know, as it has regularly been noted, not all businesses are likely to survive the impact of the global pandemic. And I suppose if there is a precedent of sorts in terms of what that might mean for pension schemes, we could look back 12 years or so to the financial crisis of 2008 and what happened there in terms of the increased number of pension schemes that went into a pension protection fund assessment and ultimately transferred to the pension protection fund. And there was a spike in assessment and transfers round about the 2010-2011 period. And it may be something that, you know, this is something that needs to be planned for over the next couple of years. Maybe not this year, maybe not next year, but possibly 2022 and beyond. The resultant impact, of course, not just being more pressure on the pension protection fund, but also for ongoing pension schemes, possible implications for the pension protection fund risk-based levy. So increase in the levy that may coincide also with increases to contributions to ongoing schemes as a result of changes to the scheme funding regime, which Adrian has already talked to. If we could move on, please, Kaz. So just looking forward then, so beyond the end of this month, I hope that most trustees are aware of new disclosures which have to be made from the 1st of October in terms of updates to the statement of investment principles, and for any annual reports and accounts which are signed on or after the 1st of October this month, additional information that must be put into reports by way of so-called implementation statements, including comments around trustees' policies on responsible investment. My expectation in terms of enforcement of these additional disclosures for this year at least is I would hope the pensions regulator would take quite a pragmatic approach, as they did in the earlier years of the additional disclosures which had to be made for DC pension schemes in the chair's statement. So in terms of gleaning the additional information which needs to go into the annual report in particular, where most of the work is, I think it's worth pointing out that the regulations are couched in the shape of the trustees exercising best endeavours to find the additional information, and where it's not possible to get it in the prescribed timescales for this year's, then an explanation of why it couldn't be obtained, and probably a reference to the fact that attempts will be made to get it in future years. And I would hope that that will suffice to avoid any penalties for breaches, at least in this first year of operation of the changes which come into force in 2020. And sticking with potentially October, although maybe later, and depending on what happens with the global pandemic, we are due the autumn budget, which is usually October, November time. We are very aware of the potential cost to the taxpayer of things like the coronavirus job retention scheme. I think back in the sort of April-May update, you know, there was the estimates of a cost to the Exchequer of some 150, 160 billion. I've not seen an up-to-date forecast, but I suspect it has only gone north of that. And no doubt there will be measures in the budget to recoup that. But there is often speculation around potential changes to pensions tax relief. And I'm quite cognizant of the fact that the Sunday Times, I think just last week or the week before, reported that there is a rumour going around the possible abolition of higher rate pensions tax relief on contributions by workers to their occupational pension schemes. So something to look out for in the budget is whether there is tweaking of pension tax reliefs and perhaps a recommencement of the debate about whether our marginal rate tax relief system should be replaced by a system where there is a single rate of relief set somewhere between maybe basic rate at 20%, maybe up to around 30%, which was mooted in an earlier consultation. I think Jane alluded briefly to the Lloyds Banking Group hearing and the 2018 judgment that trustees must address benefits for inequalities arising from guaranteed minimum pensions. Something else to look out for is the ruling in the third Lloyds Banking Group decision, which is looking at things like past transfers or other full settlements like trivial lump sums, and where liability might arise if past transfers and full settlements had not already been adjusted for GMP equalisation. I think my early message to trustees of pension schemes and to their administrators is that there seems to be a strong school of thought that the schemes involved, the transferring schemes who paid out transfers which were not equalised for GMPs, will have a continuing liability for the uplift in benefits to address the GMP inequality, notwithstanding the fact that those schemes might have thought they had been fully discharged when they paid their transfer values or trivial lump sums. This is going to throw up all kinds of issues, not least the potential for records or the lack of them for transfers going back maybe 20 or more years. But hopefully we will see some guidance when the judgment in the third hearing is published, which with a prevailing wind might be sometime early next month after the summer recess for the courts ends at the end of this month. We're also expecting some guidance from the industry around how to deal with the thorny tax issues of GMP equalisation. That is currently with HMRC for sign-off, and again, hopefully publication should be able to take place within the next few weeks. And maybe also sort of following on from the talk that Jane did on the PPF compensation levels and the UK legislation not being consistent with EU requirements. We have, of course, left the European Union subject to the transitional period, which ends on the 31st of December this year. It's looking increasingly like we are going to leave the European Union proper without a formal deal. And so trustees very much should have Brexit back on the risk register. There are obvious things, such as issues for pension schemes that pay pensions overseas to other European countries, whether there will be any problems with that on or after the end of this year. And just again, taking a step back, for trustees who have employers, who have businesses that are dependent on relations with EU countries, consideration should, of course, be given to the impact on the pension scheme of the end of the transitional period on the 31st of December in the context of the current scheme funding regime and integrated risk management considerations. So are there any implications for pension scheme investments? Will the end of the transitional period, probably with a no deal, have an impact on the employer covenant? And what are the potential knock-on effects for that in terms of the ongoing funding of any defined benefit pension schemes? Some things for Q4 this year, and just looking beyond that, if we could move on once again, please, Kaz. Beyond 2020, Guy Opperman, the Pensions Minister, was speaking at a webinar just yesterday, and he said he was very, very confident that the next pension schemes bill should receive royal assent by the end of this year. So we'll then be consulting on some of the detailed regulations in 2021 with a view to them coming to force next year. That'll affect scheme funding, that'll affect the pensions regulator powers, that will affect the pensions dashboard, and maybe even things like individuals' rights to take cash equivalent transfer values from their pension schemes. A consultation has finished on the possible replacement of the retail prices index with the consumer price index as the measure for price inflation, which if it goes through will have an impact on pension schemes. Now, as originally set out, no change was going to be introduced before 2030. That was brought forward to 2025. I'm expecting an update on the government consultation on this in the budget, and given that it has implications for government finances too, I wonder if there will be something in budget 2020 actually bringing forward the date of change before 2025. Something, you know, again to look out for, possibly as early as October in terms of announcement at least, although there would be no immediate change from RPI to CPI. And just finally, mainly because it was in the headlines again over the past couple of weeks, the current minimum pension age for taking benefits from a pension scheme, other than in cases of ill health, is 55. That was increased from age 50 back in 2010. The government has reaffirmed its intention to increase the minimum pension age from 55 to 57, probably by around 2028. And it's something I think, you know, for members of pension schemes to be aware of, who under that timetable would still be able to take benefits at 55 before the increase in minimum pension age. Because if this change is introduced in the same way as the previous change, then not taking advantage of the ability to take benefits before 57, before the change kicks in, means that these individuals would have to then wait another couple of years before being able to access their pension benefits. So it's down the line a little bit, but something that is maybe worth covering off in a trustee newsletter in future years. And really, that's the kind of things that we have on our knowledge management radar at the moment. Kaz, if we could just move on one slide, please. I'm just checking the Q&A box, and there is plenty of time for anyone that wants to ask questions of any of the speakers today. And perhaps, you know, just maybe with a view to generating some debate, if I could put a couple of questions out there. First, one Adrian and also one to Jane. So my question to Adrian is around the timing of the introduction of the new scheme funding regime, which I've said could be around, a year from now. And there is this big concern about pressure to move more towards the fast track approach, that this could mean more money going into more pension schemes more quickly, at a time when many businesses will struggle to find that money. So, Adrian, I mean, I know you act with sole trustee appointments and work with other trustees. What's the sort of general discussion with trustees just now on fast track and bespoke? And I wonder with fast track, depending obviously on the assumptions that are set, that there is a concern that it just means that there are more demands on employers. But consideration, I think, also needs to be given as to how that would be set off in terms of sometimes material reductions in advisor fees, both for trustees and employers. Are these the kind of debates going on just now?
Yes, well, I think there is sort of two camps. I mean, there's obviously for the types of schemes that I'm involved with, generally the employer's sponsoring employer is suffering due to COVID-19, and in certain circumstances we've had requests for deferral of contributions during this difficult period. So I think the wider debate is, which schemes are actually going to be in a position to adopt the fast track approach, because it seems that you would have to have a relatively strong employer covenant, and that your scheme is because of that able to take sort of an additional element of risk, whereas versus a weaker employer suffering financially and only able to pay a certain level of contributions, is not able to take such a greater amount of investment risk. So I think greater clarity is required on which schemes are really going to be able to adopt the fast track approach. We don't really have enough visibility on that yet. Haven't really had any sort of conversations about the sort of costs impact of that, but I think that will develop perhaps more during the second part of the consultation, and I'm sure that advisor firms such as actuarial and investment firms will be gearing up to be able to provide sort of bespoke models for a fast track approach that they want to kind of sell to their clients.
Okay, yeah, thanks, Adrian. It does sound, as ever, the devil will be in the detail, and it's I think quite telling that notwithstanding the size of the first consultation on the new code of practice, there's actually still a lot of information that we still need to properly understand just where the population of DB schemes are going to end up in terms of the twin track approach. Jane, my question for you is really sort of goes towards the point that you made right at the end of the presentation on cases and PPF compensation levels. So as you pointed out, both the Pension Protection Fund and the Department for Work and Pensions are appealing against the most recent Hughes decision. I think one on the cap and one on how the 50% works. I mean, but what's the kind of views in the pensions lawyer community about the Hughes decision itself? Whether it was a sound decision, and what are the likelihood in terms of either appeals? And I did also wonder, just in the context of the end of the transitional period for the European Union, that one of the options open for the DWP and government is actually after the end of this year is to effectively, I suppose, effectively go against the Hughes decision. Is that probable or even possible?
Okay, so pensions views around the Hughes decision, I think it's sort of in line with the other cases that we've been seeing, and that it has sort of emphasised the fact that, as we've been seeing in recent cases, it should be 50% of the threshold. And I suppose with the cap that is in place, it does affect members getting a lot less than that, and it is quite harsh when people are losing 60 to 70% of their benefits. I've not seen many views suggesting that the decision in Hughes was wrong, but that's not to say people don't think that. With the appeals, it's given that this was a High Court decision, it is possible that the Court of Appeal will accept the appeal request from the PPF and the DWP, but that's sort of just a waiting game to see when the Court of Appeal come back to us on that. I think the last bit was in terms of Brexit and would we deviate from the position in Hughes. Generally, I think the position will be that any cases that have come down to us from the CJEU are probably still going to be good law, in that we will still be applying the European law that is currently in place. So whilst the European Court decisions may no longer still be binding, it's probably still a good precedent for the PPF to maintain following those decisions.
Yeah, thanks, Jane. I mean, that was comment that I'd kind of heard on this before. I just wondered whether there had been any movement from that, given sort of recent government actions in terms of the negotiations with the EU. I'm thinking around things on the internal markets bill, and how that has been viewed by opposition parties, and even by some members of the Conservative Party.
Yeah, I've not heard of any movement, but I suppose we'll wait and see what happens with the next round of Brexit discussions. You never know what might be around the corner.
Okay, thanks, Jane. Okay, I'm just checking the Q&A board again, and it does look as though there are no further questions on this. So we will wrap up at this point. I can just thank Adrian and Jane for some really instructive presentations there on some really important issues, and just conclude by a reminder that these future influencer webinars are held monthly, so please do look out for the invite for the October webinar, which our marketing department should get out shortly. Thank you very much for attending, and hopefully speak to you again next month. Thank you.